One of the easiest ways to know what the market is thinking about is to make use of Google Trends. You will know what what investors are really looking for on Google. And if they are looking for a particular stock, you will know that this stock is very popular with the market in general. And right now there is one word that is gaining a lot of popularity on Google, and it is the word stagflation. Today we will define stagflation. As a value investor, what do I see in stagflation? Will we see stagflation in the United States in the coming years? What about the rest of the world? These are the questions we are going to answer today. Before we talk about this, please make sure to smash the like button for the YouTube algorithm. If you are new to the channel, my name is Ishfaaq. I am an elite popular investor on eToro. Please make sure to subscribe and hit the notification bell so that you don't miss the coming videos. Let's first define stagflation. The word stagflation it's a portmanteau word from stagnation and inflation. Let's talk about inflation first. Inflation is an general increase in prices. Some people will define inflation as an increase in money supply, but let's say in general for the average person, what is inflation is that you're going to the supermarket to buy something today, it's $100. Next year you go and you buy it, it's $108. You can say that inflation rate is 8%. So the price has increased by 8% over that period of time. You may argue whether it's because the dollar is devaluating or whether prices are increasing in general. We are not going to talk about inflation today. The next part is stagnation. Stagnation means something that is not growing at all. So the economy is not expanding or it is not receding. So we don't have expansion or recession. We have more or less an economy going straight like this. You may say this is good, we don't have to worry about anything, but actually over the long term, we expect the economy to be growing. When we are talking about stagnation in the economy, it's not that the economy did not grow for a year. It's mostly about the long term. So over the long term, over a even 5-year period, you expect the economy to be growing. Maybe there is going to be a recession, but then there is recovery, there is expansion, and that expansion is expected to be bigger than the recession. That's why the economy over the long term just grows. When we have stagflation, that is stagnation plus inflation, it means we have higher prices. Prices are going higher and higher, and the economy is not growing. So this is something very bad. Stagflation is very, very bad because usually when we have economic expansion, we are going to see inflation. And then in order to control inflation, the Federal Reserve System will raise interest rates. When they raise interest rates, inflation rate will go down and the economy will consequently go into a recession. So we have these boom and bust cycles. But when we have stagflation, then it becomes hard to control the economy. How are you going to control inflation if the economy is not growing with inflation? If you try to raise interest rates, then it leads to a recession, which is bad. So that's the problem with stagflation. Let's use an example of when stagflation happened. It was in the 1970s. As we know, in 1971, on the 15th of August 1971, there was the Nixon shock. President Richard Nixon. Why did he do that? Before that, there was the Bretton Woods agreements. Most of the other currencies all around the world, they could be pegged to the dollar. And the dollar itself was on the gold standard. So you could, in theory, convert your dollars into gold. Because the dollar was losing its value and they did not want their own currency to lose its value with the dollar, they wanted their dollars to be converted to gold. So there was a high demand for gold, and the US knew that they don't have that much gold to give to these people. So the administration back then, the Nixon administration, they decided that they would take the US dollar off the gold standard. So gold is no longer linked to the US dollar. The US dollar can be free floated, and what happens then? It can fall, the price can fall, it can rise, so it is a free market. And the price of the US dollar actually fell. So we saw inflation after the Nixon shock. The inflation would have been here, but it would have been in different ways if the gold standard was still in existence. We don't know how it would have happened, but it would have been here in different ways. So we had this inflation in 1971, in the early 1970s. And then in 1973, there was the Yom Kippur War. Many Arab states, they went to war with Israel, and the US supported Israel. So there was an oil embargo on the US. These Arab countries, they did not want to sell oil to the United States anymore. This caused oil prices to go up. I'm telling you this story because it's a little similar to what we are seeing today. there's a war, there is also oil prices going up. That's why I'm telling you this story. So what happened in the 1970s? We need to look at the past, then we will know how we can look at different scenarios of what may happen in the present and also in the future. So in the early 1970s, we had this situation that oil prices are going up. So we have inflation because oil is the most important commodity in the world. We have inflation because of higher oil prices. We have inflation because the dollar is devaluating. The dollar is no longer pegged to gold. And the Federal Reserve System, they wanted to act. What they are supposed to do in such a scenario is to raise interest rates, but raising interest rate was not enough to fight inflation. So they raise interest rate, it caused a recession. So it caused a recession, which is bad. People are unemployed, but inflation is still here because normally unemployment rate also plays an important role in all of that. Normally, if unemployment rate is low, it is supposed to cause inflation. But then, what do you do when there is a recession? Unemployment rate is going up, then inflation is going to go down, because when people have jobs, they're going to spend more money, and spending more money means they're going to put more pressure on the demand side on any products, and prices are going to go up. So unemployment rates also has an important role to do in that. But in the early 1970s, this recession that was caused, we had high oil prices, unemployment rates was increasing, we have a recession, we had inflation. All of these are not supposed to be happening together. Usually, if unemployment rate is high, inflation should be going down. But this was not happening. And interest rates also were up. So it was getting hard for companies to take credit. This caused stagflation of the 1970s. Now let's come to the present and do a comparison. Why we are seeing the same things? We have this war in Ukraine, and it is sending oil prices higher. Then we had not really the US dollar getting off the gold standard that already happened in 1971. But what we are seeing is that the US dollar has weakened in recent years because of money printing, quantitative easing, and interest rates being at 0%, almost 0% for more than 13 years. And you look at the Federal Reserve System today, they are lagging behind inflation. Inflation is at 8%, but interest rates are only at 0.8%. So there is almost a 7 percentage point difference between inflation and the short-term interest rates. And if you look at the past, when the Federal Reserve System tried to control inflation, what they did is that they raised interest rates to sometimes higher than inflation rate. That's how you control inflation. And how in the 1970s, how this stagflation problem was solved? It was solved by Paul Volcker. He was not very popular back then, but today most people will say that he was the greatest Federal Reserve System chairman because the way he saved the US economy. So what did he do? After the recession of 1970s, when the economy was expanding again, inflation rate increased again, and it was even bigger than it was in the 1970s. You will see that inflation actually peaked in the early 1980s. So when inflation was that high, and in 1979, Paul Volcker was appointed as the Federal Reserve System chairman, he decided that he had to fight inflation. And the president back then was Jimmy Carter. I'm not going to say that Jimmy Carter was a good president. Maybe he was the worst president in the last 50 years. Maybe. If we don't count Joe Biden. But one thing he did right was that he left the economy in the hands of Paul Volcker. So he knew that he doesn't know what to do. So let Paul Volcker take charge of the economy. And he took decisions that I don't think anyone would dare to take today. The way that he decided to fight that inflation. He knew that if he doesn't raise interest rates at some point was over 20%, so 22% effective interest rates, effective federal fund rates. So he raised interest rates higher than inflation rates. That's how he was able to fight inflation. Is Jay Powell going to do the same thing today? I don't know. He's no Paul Volcker. And there is another problem with raising interest rates so high is that the government has more debt than it had in the 1980s. So if interest rates are going to go up, every time the government will try to refinance its debt, it will have to issue debt with higher coupon. It will have to issue bonds with higher coupon. And this is not going to be good for the government when they have so much debt as they have today. So stagflation is a big possibility. And the way we are going to fight stagflation this time, I don't know how we will do it. Some people are still saying that this inflation is transitory. Maybe I hope it is. I hope really it is, and that inflation really is going to go down because now it was 8%, now it's 8.3%. Maybe that's already the peak. Maybe it's going to fall down to even 4%. The Fed can still manage it by raising interest rates. Maybe the Fed will have to force a recession if interest rates are rising, because as we talked about in an earlier video, the yield curve has inverted, but the Fed usually in such a situation would be cutting interest rates. Right now, they're raising interest rates. So they know that they have to control inflation. That's the priority of the Fed right now, controlling inflation. Maybe today you will see that the economy is booming, unemployment rate is going down, but all this is leading to more and more inflation. And if the Fed has to put a brake on the economy, it can be a very hard one. So I'm not going to predict what is going to happen to inflation. It all depends on what happened to inflation. If inflation stays above 5%, the Fed will have to raise interest rates more rapidly. But if it falls to, let's say, 3%, 4%, maybe then they will have more control on the economy. Maybe then they will have more control on raising interest rates. We have not discussed quantitative easing at all. So there was all this quantitative easing. Now the Fed will be the one selling the most assets. All these bonds that they were buying, they are going to sell all that. Quantitative tightening. And this will have effects on asset prices, on stock bond prices. So for me, as an investor, of course, I like to look at all of this. It's interesting and it's important to look at the economy to know what is really happening. But don't base your investments on this, because you don't know what will happen. Nobody would have thought in the 1970s that Paul Volcker would be here and who would dare to do what he did, to actually cause the economy to crash, to cause a recession. Nobody would have thought that someone would dare to do that, because politicians normally they don't do such things. And Jimmy Carter, I don't know, maybe he already knew that he was not popular, he would never get re-elected, and he decided that, okay, we have to end inflation, take that risk. So it happened. Nobody would have thought that. So if you would have made your investments thinking that someone would actually cause a recession just to stop inflation and that interest rates would go to 22%, you would have lost money, because it was impossible to predict that such a thing will happen. And this time also, it is impossible to predict what will actually happen. So don't base your investments on that. Don't base your investments on macroeconomics. Yes, there is this scenario, we are going to see stagflation. And I have been talking about stagflation, I think, since 2020. When people were saying inflation, recession, I said, no, the economy will recover. It's not recession, it's not going to be a depression, it's going to be stagflation. And we are probably going to see stagflation. For how long? I don't know. Nobody knows. But I'm basing my investments, my portfolio, on stocks that can do well in any scenario. Of course, some scenarios will be better. Of course, if we are going to see stagflation, most companies, most businesses will be affected. But some businesses will be affected more than others. And it all depends on valuations. A company having $6 billion in free cash flow a year, because of stagflation, let's say the free cash flow falls to $5 billion, but the company which had a market cap of $60 billion, so 10 times free cash flow, now because of this, it fell to $40 billion. Now it's only 8 times free cash flow. So it is cheaper according to me, and probably a good investment. These are the things you need to think about as an investor. So let me know in the comments whether you think we are going to see stagflation or not. Thank you for watching this video. Please like, subscribe and share. Please watch these 2 videos if you can miss them. Have a nice day and goodbye.